Welcome to the Explainer. So, we are looking right now at the final weeks of summer 2026. And let me tell you, we are sailing straight into an unusually active, perfect economic storm. We're seeing geopolitical tectonic plates shifting, the once invincible AI narrative is showing some real signs of exhaustion, and the very plumbing of our financial markets, well, it's undergoing a radical transformation. Today, we're taking the complex data surrounding this late August macro environment and breaking it down piece by piece.
All right, let's dive right in. The wild volatility we're experiencing isn't random. It's actually being driven by three distinct compounding forces. First up, we've got new aggressive policy and trade fronts opening up. Right alongside that, we have a severely fatigued tech sector that is frankly standing at a major crossroads. And finally, structural shifts in market mechanics, things like the impending 23-hour trading clock, are creating these hidden traps for investors. When these three pillars collide, it creates the absolute macro chaos that we have to navigate before a historically volatile September.
Here is our agenda for this explainer. 1. The August Convergence. 2. Dual front economic wars. 3. AI fatigue and evolving risk. 4. New market mechanics. 5. The macro wildcards. And 6. Finding portfolio ballast.
All right, Section 1, the August Convergence. Let's set the stakes for our immediate volatility horizon. We are facing a total gauntlet of incoming catalysts, and you can really think of it like a ticking clock. Over just a few days in late August, we get hit with housing and consumer sentiment data, instantly followed by high-stakes tech earnings, where NVIDIA is already showing a near 7% slide, while Marvell pushes positive. Right on the heels of that, we have monetary policy updates from Fed Chair Warsh moving into September Treasury operations, and it's all leading up to a massive structural shift on December 6th with the launch of the 23-hour trading clock. What is absolutely crucial to understand here is how tightly these events compound upon one another. There is practically no breathing room.
Moving on to Section 2, Dual Front Economic Wars.
Let's look closely at our first pillar of volatility. The U.S. is deploying two very different economic strategies right now that contrast intent with market reality. On one front, we have Operation Economic Outcast targeting Iran. The Treasury went after 60 entities, but because China absorbs roughly 90% of Iranian oil exports, the actual market impact was incredibly muted. In fact, crude oil slid 2.4% as immediate war fears just kind of faded. But contrast that with the North American tariff trap, a blanket 50% tariff on autos and steel from Canada and Mexico starting January 1st. Because our supply chains are so hyper-integrated, this isn't just a political flex, it is a severe structural hit. Automakers dropped sharply in a single day, with GM estimating a massive $2 billion hit to their operating profit. Section 3. AI fatigue and evolving risk. As if fractured trade wasn't enough to deal with, the tech sector narrative is shifting entirely. Notice the stark divergence in the data here. The broader semiconductor index actually suffered an 8% slide over 7 days. That's the longest losing streak since September 2022. NVIDIA alone just can't shoulder the market's momentum anymore. But in stark contrast, Marvell is breaking out. They secured a massive $120 billion custom chip deal with Google, which pushed their stock up 3% against the broader trend. The market is becoming fiercely selective. To figure out why this shift is happening, we really have to look under the hood of the AI ecosystem. The old model was super simple. Supply the hardware, get the cash. But NVIDIA has evolved into an ecosystem financier. They supply the hardware, sure, but now they're offering vendor financing and taking equity stakes, which means their actual cash flow is delayed. They are highly exposed to client monetization risk. So, the crucial takeaway is this. NVIDIA now has massive skin in the game. This perfectly mirrors the ill-fated pivot that telecom equipment makers made right before the dot-com bust. If the clients fail to monetize the AI, those financial guarantees come due, and a systemic risk cascades. $2.5 trillion. I just want to let that number sink in for a second. That is the sheer amount of global market value recently erased in the fallout of this highly concentrated AI exuberance. When the narrative finally cracks, the financial destruction is immense. And to ground this macro data in actual human reality, let's look at the Kospi fright ride. Driven by these trillion-dollar valuations in memory chip giants like Samsung and SK Hynix, the South Korean market experienced a gut-wrenching 40% crash over just 6 weeks. But the real story? It's the retail impact. The financial pain of this crash fell disproportionately on South Korea's individual retail investors, colloquially known over there as ants. It's a brutal cautionary tale about the very real dangers of unchecked, heavily concentrated retail trades in the AI space. Section 4. New market mechanics. Beyond trade wars and tech fatigue, there are some pretty hidden structural risks built directly into the plumbing of the markets right now that we really need to expose. Many investors believe that if an index updates its rules to include hot new stocks, it just guarantees outperformance. Well, we call this the SpaceX illusion. Morningstar aggressively modified their rules to include SpaceX's massive IPO, while the S&P 500 rigidly excluded it. The result? Both indexes returned nearly identical 2.5% gains, and that was entirely because small-cap stocks surged and buffered the broader market. Index shopping, as it turns out, is just as perilous as stock picking. And speaking of perilous market mechanics, we are currently living through what's being called ETF Darwinism. The market is so explosively saturated right now that we've seen 217 ETFs shut down this year alone. That is double the rate from last year. And this aggressive culling is happening right as the market prepares for the December 6th launch of a 23-hour trading clock. When you combine an oversaturated, failing fund environment with overnight trading, you introduce severe risks of thin liquidity and wild, retail-driven volatility while the rest of the world is literally asleep. Section 5. The macro wildcards. We've looked at the foundational pillars, but we also have to keep an eye on the fringes. So, it brings us to the multi-trillion-dollar question, doesn't it? With AI fracturing, trade wars compounding, and market plumbing undergoing this Darwinian stress, where exactly does a smart investor find a safe harbor? Well, first, we kind of have to navigate these wildcards. We have crypto institutionalization, where U.S. stablecoins are now legally intertwined with treasury bond management. We've got corporate AI harvesting, where executives are literally telling their employees to chat in public Slack channels so deployed AI agents can scan their everyday conversations for business insights. And just to show you how detached the culture has become, the new Silicon Valley status symbol isn't a flashy car. No, it's Sam Altman's $180,000 custom titanium watch inscribed with the phrase, "Compute is destiny." It is a wildly unpredictable fringe environment out there. Section 6. Finding portfolio ballast. Okay, let's take a breath, step back from the edge a bit, and look at the solution. It is time to find some strategic shelter from this August convergence. What we're looking at is the synthesis arc. This is the defensive strategy advocated by Bank of America for this exact macroeconomic regime. Think of your portfolio like a seesaw. On one side, you have the heavy, unpredictable volatility of mega-cap growth and AI fatigue. To balance that out, you need the massive ballast of large-cap value. Because of our current demographics and the new interest rate regime, inflation-protected income is heavily favored right now. Value has actually been operating with incredible consistent outperformance, essentially acting as the ultimate shock absorber. Now let's see how this actually builds in the data. This is absolutely crucial. The very definition of value has transformed. It's no longer just traditional, slow-moving, old economy industrial stocks. Today's value screen captures formerly high-multiple tech and financial stocks that have totally de-risked and are now trading at highly attractive multiples. Notice how companies like Robinhood, Centene, and Eli Lilly are showing top quintile EPS growth? They are acting as the new stealth strength in the market. Which brings us to our final executive mandate. You absolutely must brace for structural supply chain friction. Do not treat these new North American tariffs and Middle Eastern sanctions as temporary political posturing. They are permanent operational costs that are going to eat into legacy margins. As you navigate the compounding volatility of this August convergence, I really want to leave you with a vital question to consider. As the AI burden shifts and supply chains fracture, is your portfolio still dangerously holding on to the momentum of the past, or are you actively anchoring into this new stealth strength? Thanks for joining me on this explainer. I'll catch you next time.